Hey everyone, welcome back to Corporate Decoder, the place where we decipher those massive corporate filings so you don't have to. Today we're diving into Alliant Energy's latest annual report, and let me tell you, there are some interesting things brewing and some real potential shocks buried in this paperwork, but you'll have to wait and see what they are. This report covers Alliant Energy along with its main subsidiaries like Interstate Power and Light Company and Wisconsin Power and Light Company. But before we jump in, there's a crucial disclaimer. This report contains what are called forward-looking statements. Basically, anything that talks about the future is a guess, and these guesses are subject to a whole bunch of risks and uncertainties, so don't take them as gospel. First off, the basics: Alliant Energy provides electricity and natural gas services primarily in Iowa and Wisconsin, serving around 1 million electric and 430,000 natural gas customers. This means a lot of what happens depends on regulations and getting approval for things like rate changes and new construction, which can be a real headache and create delays. Now, let's talk about the people powering this operation. Alliant Energy employs almost 3,000 people, with a large chunk of them part of bargaining units or unions. Keeping these employees happy and safe is a big deal, as any labor disputes could really throw a wrench in the works. Safety is also a top priority, and they're constantly working to improve their safety performance to avoid accidents and injuries. Moving on to regulation, Alliant Energy is under the watchful eye of the Federal Energy Regulatory Commission, or FERC, as well as state-level commissions in Iowa and Wisconsin. These agencies control everything from electricity and gas rates to construction approvals, environmental regulations, and even affiliate transactions. Failing to comply with these rules can result in fines and other penalties, seriously impacting their bottom line. Environmental regulations are a particularly hot topic, and it's a never-ending battle to comply with current emission laws and any future changes, especially when it comes to greenhouse gases. Alliant Energy faces pressure to reduce these emissions and invest in cleaner energy sources, but getting all those costs covered in customer rates isn't always a sure thing. Alliant Energy's strategy revolves around providing affordable energy, making smart investments in customer needs, and growing their customer base. A key part of their strategy involves large construction projects, from wind and solar farms to natural gas facilities and infrastructure upgrades, but these projects are risky, and the potential for cost overruns, delays, and regulatory roadblocks is always there. Alliant Energy participates in the Mid-Continent Independent System Operator, or MISO, market. MISO is responsible for keeping the lights on across the region. This MISO system includes capacity reserve margins, which may force the company to adjust its current plans, add resources, or even buy capacity in the market at potentially higher costs. One big challenge for Alliant is managing the prices of fuel like natural gas and coal. Disruptions in the supply and delivery of these fuels or big price swings can really hurt their finances, especially since they might not be able to pass all those costs on to customers quickly enough. Extreme weather is also a growing concern. Excessive heat, excessive cold, storms, wildfires, or natural disasters can seriously disrupt Alliant's operations, causing damage to facilities, impacting construction efforts, and ultimately affecting their ability to deliver power to customers. Looking at the specific operations, their electric utility business is seasonal, peaking in the summer due to air conditioning. Competition is heating up too, with more customers generating their own power and looking for alternative energy sources. The natural gas side of things is all about staying on top of demand and ensuring an adequate supply through long-term agreements. However, just like with electricity, competition exists in the alternative fuel space, but natural gas service has generally been a popular pick over propane because it's a more cost-effective solution. One thing that always stands out in these utility reports is how much the weather matters. More cooling degree days, meaning hotter summers, drives up electric sales, while more heating degree days, aka colder winters, boosts natural gas demand. Now let's dive into the financial numbers for Alliant Energy as a whole, followed by a look at the two main utility subsidiaries, IPL and WPL. For the entire Alliant Energy operation, electric revenue was just about flat and gas revenue actually decreased compared to last year. At the same time, their costs for fuel and purchase power actually went down, which is a good sign. Overall, it really nets out to earnings that are just about flat this year. Moving into the financial and operating review for Interstate Power and Light, or IPL, we see retail customers are responsible for the bulk of the revenue, but sales for resale are responsible for a considerable amount as well. In other words, IPL is both directly providing power to end customers and it sells it to other power companies that are taking it and selling it to the end customer. It's also interesting to see that the amount of total revenue was essentially flat across the last 2 years. Looking now at the Wisconsin Power and Light Company, or WPL, you see the same story. Retail customers are responsible for the lion's share of the revenues, with similar types of customers and industries as IPL, including farming, agriculture, industrial manufacturing, chemical, packaging, and food. The amount of megawatt hours sold is a little higher this year, and so is the revenue, so we can tell that they're doing slightly better than IPL. Looking at gas operations, total revenue decreased about $80 million year over year. We can see a slight decline in retail customer revenues. The revenue per unit sold also declined by about $1, while gas costs were about $1.30 lower. There are a number of federal and state legislative and regulatory factors that the company is contending with right now. These include things like greenhouse gas regulations and the cross-state air pollution rule. They're also evaluating a new source performance standards for combustion turbines. Navigating these environmental regulations is essential, but can also be complex and expensive. One thing we see is Iowa law actually allows utilities to request rate-making principles prior to making investments in Iowa. We also see that the advanced rate-making principles in their 2023 order included a consumer protection plan, which is another sign of this relationship with the Iowa regulators. Finally, we also see that IPL's and WPL's gas demand planning reserve margins are slightly above their forecasted requirements, which means that they have a little bit of a buffer if there are more customers than expected. Now it's time to talk about the risks. These are the things that could prevent Alliant Energy from achieving its goals, and it's important to pay attention. For instance, the demand for energy might decrease if the economy slows down or customers switch to alternative energy sources, for instance, through increased use of solar. The company identifies several factors that could disrupt the business, including extreme weather, which causes higher expenses for them. But one thing that has to get your attention in the modern era is cybersecurity. And in case the threat of that ever goes away, they specify that they must hire and retain skilled workers and be ready to implement new technology changes. For all of these things could seriously impact their financial performance. Alliant Energy has a lot of capital projects that it wants to undertake, but it has a variety of levers that it can use. These range from accessing funds from the capital markets to issuing more debt and even potentially receiving proceeds from the US Department of Energy's Loan Programs Office. Alliant Energy does not have any material legal proceedings right now, although in a report this size, that is always worth keeping an eye out for. So what's my take after decoding this corporate report? Alliant Energy has laid out a pretty clear plan. Alliant Energy appears to be taking important steps to manage their business, focusing on things like growing demand, investing in smart grids, caring for their people, and promoting safety. But they face quite a number of risks that could impact its future, and it's operating within a highly regulated industry and has significant exposure to market volatility in fuel and labor costs. From a financial point of view, Alliant Energy is looking pretty solid for the next few years. The company has laid out capital investments of over $2 billion from 2025 through 2028. Revenue is expected to increase, however, earnings have been flat, so they will need to better their earnings potential for a buy rating. One positive indicator is that a major rating agency, S&P, maintains a negative outlook for the stock, which means that there is more possible upside than downside, with the current financial news being already baked into the price. Based on these factors, a fair price range for Alliant Energy LNT is between $55 and $60 per share in the intermediate term. That is a neutral to slightly bullish outlook. This stock could be a good pick for long-term investors, but there are several potential factors that could put them at a disadvantage in the next 12 months. Thanks for watching. If you found this helpful, please subscribe for more.